Hey there! Are you curious about how equity compensation can play a role in your financial future within a private company? This week, we'll dive into the ins and outs of equity compensation to help you understand how equity compensation works in a private company and how it might benefit you. Understanding equity compensation. Equity compensation is a non-cash payment that represents ownership in a company. It's often used by private companies to attract and retain talent without spending large amounts of cash. In a nutshell, it gives you a stake in the company's success. Types of equity compensation. Number 1. Stock options. Stock options grant you the right to buy company stock at a predetermined price known as the exercise or strike price. If the company's market value rises above this price, you can buy the shares at a discount, creating potential profit. Number 2. Restricted stock units. RSUs are company shares that are given to employees as a form of compensation. They vest over time, meaning they become yours after a certain period or once specific milestones are met. Number 3. Employee Stock Purchase Plans, ESPPs. These plans allow employees to purchase company shares at a discounted rate. They often involve payroll deductions, making it easier to invest gradually over time. How equity compensation works in a private company. In a private company, equity compensation can be more complex due to the lack of a public market for the shares. Here's a breakdown of how it generally works. Vesting schedules. Equity compensation usually comes with a vesting schedule, which dictates when you acquire full ownership of the equity. Vesting may occur over several years or be tied to performance metrics. Common vesting schedules include cliff vesting. You receive the entire equity grant after a certain waiting period, typically 1 year. Graded vesting. Your equity is vested gradually over a period such as 25% per year over 4 years. Valuation and liquidity. In private companies, determining the value of your equity can be challenging since there's no public market for the shares. Valuation typically involves periodic company assessments. Liquidity is another issue. You might not be able to sell your shares until the company has a liquidity event, such as an IPO or acquisition. This means equity compensation can be a long-term investment rather than immediate cash. Potential benefits and risks. Benefits. Alignment of interests. With equity compensation, your success is tied to the company's growth, aligning your interests with those of the company. Wealth accumulation. If the company performs well, your shares may increase in value, resulting in substantial financial gains. Risks. Valuation changes. The value of your equity may fluctuate based on factors outside your control. Lack of liquidity. You may not have immediate access to the cash value of your equity, making it crucial to balance it with other forms of compensation. Understanding how equity compensation works in a private company is vital for anyone considering working in such an environment. While it offers a unique opportunity to be part of your company's growth, it comes with its own set of challenges related to valuation and liquidity. By weighing the potential benefits and risks, you can make informed decisions about your financial future and make the most of your equity compensation. Remember, knowledge is power when navigating the world of private equity compensation.